I share quite a bit of Johanna's reasoning, but feel, I believe, even more strongly than she does. Frankly, I am disappointed in the program of work, and here's why. It articulates some reasons and then advances some solutions, but the solutions are entirely too timid relative to the reasons that are advanced, and so there is this mismatch. What are the problems that this work is attempting to address? Well, the first problem is tax competition. And here it articulates really two things that are wrong with tax competition. The first is that corporate tax rates are too low, and the second is that they differ too much across countries, creating a non-level playing field. Let's start with the corporate tax rate being too low. How do we know that? You know, the average tax rate among high-income countries is roughly 23% these days. Do we have any study ever that says the optimal corporate tax rate is higher than that? I'm not aware of it, if there is such a study. But the political system has decided yes. Somehow corporate tax rates are too low. I'm not sure on what basis, but we have that. What about the non-level playing field? It is true, taxes differ across countries. Should they all be the same? Why would they all be the same? Is there an efficiency reason for them to be the same? I can tell you this, economic theory does not say that. Economic theory does not say, and frankly never has said, that tax rates should be the same everywhere. Economic theory says if you want efficient taxes, they should be different everywhere, depending on the economic conditions in different places. So the fact that tax rates differ, the fact that we have a non-level playing field, is actually consistent with efficiency, and having the same tax rate everywhere would be inconsistent with efficiency. Now, don't get me wrong. Of course, we have different tax rates everywhere. That doesn't mean that we've got the efficient outcome here. But it doesn't. But level playing field, that's not an economic concept. That's like a soundbite, and it's the sort of thing you tell introductory economics students. But once you get beyond that, it's not the answer. The Ramsey Rule, for example, 1927, since then, we've understood tax rates actually are all supposed to be different because you want the tax rate to reflect economic conditions, supply and demand elasticities, and all of that. So level playing field, that's not an economic concept, that's, you know, a soundbite. Okay, that's tax competition. The second problem that the program of work identifies is tax avoidance, and the difficulty there of enforcing arm's length pricing. And there's no doubt there is difficulty of enforcing arm's length pricing, and there is tax avoidance. Let's talk about the proposed solutions. Again, they are far too timid given the articulation of the problems in the program of work. Let's start with the income inclusion rule to address the tax competition problem. Really, if there's tax competition, then what you need to do is to force everyone to have exactly the same tax system and the same tax rates, because then you won't have tax competition. Anything but that, and you will have tax competition. You need CCCTB plus forcing everyone to have the same tax rate. Why do you need CCCTB? Because, you know, as we've talked about, if you have different bases, it just causes nothing but trouble. Okay, we agree that, and I understand, this proposal is not one for every country to have the same tax base and same tax rates, because that's obviously politically infeasible. Would it be the right answer if it were feasible? No, it would not be the right answer. Should Austria and Mongolia have exactly the same tax system and tax rates? Why would that be the right answer? That would be pure luck for that to be the efficient or proper outcome, and I'm quite sure it's not the right answer. Should they have the same depreciation rules? Why? Does capital depreciate at the same rate in those two places? Yet the sort of logic of the proposal is that everyone really should have identical tax systems. Okay, the proposal, of course, doesn't mandate that. It just nudges countries in that direction by giving them some incentives. You know, if you look back in history to times when countries had incentives to adopt similar systems, I can think of the Americas in the 1950s and 1960s when the United States had a worldwide tax system, and there was a pretty strong incentive for capital importing countries to adopt tax rates that were the same as the United States because you would soak up the taxes that way. If you look back in time in the Americas, really only Bolivia allowed itself to, wound up doing what the theory says they should, basically adopting the US rate and roughly the US system. By the way, Bolivia did not love us for that. They didn't say, thank you, United States, for taking the messy problem of trying to decide what tax system to have and just solving that by creating an incredibly strong incentive where we don't really have much choice but to adopt your system. I don't remember Bolivia saying that. So how could you force countries, how should the program have worked? Well, you should have punitive tariffs and punitive tax rates on any country that has too low a tax rate, and then maybe that would bludgeon them into doing it. What about a country in the proposed system that does have a high enough tax rate, but doesn't adopt the income inclusion rule? Suppose, for example, Canada were not to adopt the income inclusion rule. Would that be a problem? Oh, of course it would be a problem, because then all the multinational firms would want to be in Canada. And then the capital importing countries would not have incentives to increase their tax rate to the minimum rate because the multinational firms wouldn't be subject to it because they'd all route their profits through Canada. So obviously, the proposal needs to have a system that would punish Canada under those circumstances, even though its home country tax rate would be higher than the minimum. But you need to have some sort of punishment mechanism for countries that don't adopt the system. The other thing I would add is, even if every country did adopt the same tax rate and same tax base, that is not enough. Why isn't it enough? Because then countries would compete over infrastructure and business regulation and labor rules and minimum wages and all kinds of other things that attract business. Indeed, the competition over those things would be stronger because they can't compete over taxes, and getting more business would get you more revenue because everybody's got higher tax rates under the proposal. So you intensify the competition over other things that, frankly, have more material effect than taxes do. It's far more costly, inefficient to force countries that were to adopt, other rules that may or may not be in the social interest of the country because they're not allowed to do things on taxes. Okay, that's on the income inclusion rule. What about the denial of deductions for base eroding payments? This proposal would apply to payments to related parties. That, again, is far too timid. It really should apply to unrelated parties as well as related parties. Why? Because the problem here is that firms would get advantages routing their transactions through, the problem is articulated, is that firms get advantage routing their purchases through low-tax countries. But of course, that would still be true even if you were buying from unrelated parties. Let's say that you have some good and it's being produced at a cost of 12 in the United States, but it could be produced more cheaply in a country with low taxes because low taxes make everything cheaper. And so you're still going to get transactions routed through lower tax places, even if you were to adopt the solution advanced in this proposal. The logic of the proposal really, I think, says it should be extended to unrelated party transactions. Section 77 of the document does talk about extending things to unrelated party transactions, but it doesn't intend truly unrelated party things. Those are structured transactions, where there's like a deal with the intermediary. In this case, I mean actually just any unrelated party. Query: would countries actually be willing to follow through on the denial of deductions if they did agree to it? I don't know that they would. Suppose that you have a firm that makes a normal rate of profit. It buys a good for a price of 10, and let's say it's an arm's length price, and sells the good for 12. And it's in a country with a 25% tax rate. Under current rules, it has a profit of 2, and it would pay half a unit in tax. Under these rules, if the purchase of 10 is from a country with a supplier in a country with too low a tax rate, then you get no deduction. Your tax would be 3. and now your profit of 2 has turned into a loss of 1. Would countries actually do that? Would they turn around and make taxpayers get losses on transactions when in fact they're following arm's length pricing on all of their transactions and are just earning a normal rate of profit? I don't know that they would. And of course, if they wouldn't enforce it, then I'm not sure what the proposal actually is. There is a separate question of how you would know that a payment was a deductible payment was received by an entity that was taxed at an acceptable level. How would you determine that? Would you need to know about, would it be based on what country the entity is located in? Is it based on what company in that country receives the payment? Is it based on that particular transaction? Here's the problem. Even if you had all the data, I mean all the data, and honestly provided, you don't know in any one transaction what effect that had on the company's tax bill. You don't know it. The company doesn't know it either. Because the company's got 10,000 transactions and it's got a final tax bill, and you don't know what effect that receipt had on their tax payments. So it's going to be some sort of approximation. I submit to you that inevitably it will be countries. It will be based on countries. As Johanna suggested, we're going to wind up with a new blacklist of countries. And my guess is, my question is then, if you have a blacklist, shouldn't it apply to, well, I guess the first question is, do you really want to do that? And the second is, shouldn't it apply to unrelated party transactions too? Final issue I want to raise is developing countries. About 20 years ago, the OECD advanced what it then called the Harmful Tax Competition Project. The name shortly changed to Harmful Tax Practices. And the project was remarkably successful at greatly reducing harmful tax practices around the world. Now we're back to tax competition, it seems. The old project was criticized for being less sensitive to developing countries. This document makes nods to the developing world, but it's clear that's not where its heart lies. Why? Because the reasoning in the document implies that developing countries are not that bright. Now, developing countries have difficulty competing with high-income countries, of course. They don't have the physical infrastructure, they don't have the educated workforce, they don't have the legal institutions, and they're poor. That's why we call them developing countries. So in many cases, they offer low tax rates or special tax incentives in order to get business and employment. This proposal would limit their ability to do it. Why limit their ability to do that? Well, because it's bad for Germany. Because Germany feels that if business goes to these low tax places, it doesn't go to Germany. Query whether this is true, that it's bad for Germany. There's huge controversy about that. The political system, in 2019 has decided it's bad. The economics literature I know of, it's an open question, but let's say it is bad. The document argues that this tax competition is also bad for developing countries. Why? Why is lowering their tax rates bad for developing countries, trying to get business, bad for developing countries? Well, there are two reasons pointed out in the document. The first is it doesn't work, and the second is it leads to race to the bottom. Here's the thing, they can't both be true. It can't be that offering tax incentives doesn't work and it leads to race to the bottom as people compete offering them, because the only reason why you would keep, if they don't work, the only reason why you would keep offering them and race to the bottom is because you're too dumb to realize that they're not working. Okay? Now you can argue, well, it doesn't work. Maybe it just means there'll be race to if I offer a lower tax rate, then some other developing country will also offer a lower tax rate. And to some degree, that may be true. But then that just means the developing world as a whole gets more business, and Germany gets less. I think the way to make the argument coherent is to say that what the document must be saying is that the developing world has let themselves be bamboozled into tax practices that they shouldn't adopt But not to worry, the G20 is going to solve that problem for them. My question is, if you really want to help...
This will be the final question.
If you really want to help developing countries, why not offer a tax-sparing approach here, as the United Kingdom did, Japan did, and a number of others in the past, where you permit developing countries to exemptions from this rule. But it seems that the proposal is not really about them. Okay, the proposals in the document are too timid given the reasoning. That tells you something about the proposals, or it tells you something about the reasoning. The political system has chosen the answers here and clearly asked for the reasons. Here's the thing. There may not be reasons.
Okay.